Hey guys, Freaky Finance here. This week I'm going to do PayPal. I've seen a lot of videos on YouTube about PayPal. Most of them are the same thing, just regurgitated and showing a chart. But we're going to dive into it more. PayPal is one that I own. It's currently a full position, and I'll probably keep adding under 50 if it gets there, because that way they can keep buying 10% of themselves each year at $50 a share, whereas they can only buy a 12th of themselves at 60 each year with their cash flow. But before we jump into the numbers, let's just walk through it. And most people have heard of PayPal, so that part's easy, though most people don't really understand the business model of payment providers. For our case, we'll break it up into two parts. We'll break it apart into the branded part, the PayPal button, and the unbranded part, which we'll just say is Braintree and Venmo for today's reasons. Anyway, there's 1.4 trillion that's already on the PayPal platform, so more than 350 billion every quarter, so more than 100 billion a month. It's so I'm trying to say there, it's a very big business, and it kind of rides on e-commerce growth. And I would argue it specifically rides on e-commerce goods growth. So one of the things we saw after the COVID recovery, or during COVID, say, to start with, we saw goods do very well, e-commerce goods. But then we saw, especially online, and then you saw a shift to services, say, after Omicron, and especially the spring 2022, summer 2022, and that's been fairly steady ever since, really, and it's only improved. But but the year-over-year comps for much of the goods were still weak for most of 2023 so far, and the back half of 2022. So anyway, that's kind of the pretext I want to get into. It kind of helps sets the trend for what we're going to see here. PayPal has a lot of different faucets. So you have their PayPal. Most people, I'd say their advantage is they're a first mover, so they have a trust ingrained into them. So when you pay by PayPal, you don't have a problem with the person selling you something, usually. And if there is, you have a way to get back at them. They also have Venmo, which Americans would be more familiar with, Zettle, and you have the buy now, pay later, which in Europe they've already outsourced to KKR because their underwriting ability isn't as great as they thought it was. and this will be a more balanced video because it is cheap, but it is cheap for a reason, and I do own it for a reason. Anyway, here's the position. I went to PayPal. I have it in 3 different accounts. I've slowly been adding as it goes down. It's kind of what I do. I put the other ones here for similar reasons. So Google's a little bit better than PayPal was in terms of catalyst timing wise, but PayPal at some point I think will turn around. If you believe in e-commerce of goods, will eventually come back. I think PayPal is an easy one, and it rides on a lot of things. So when the economy in general grows, it just rides with that. And it is still currently growing. It's just growing at a slower rate, which is one of the reasons why it's cheaper than it has been in the past, or at least I'd argue that. Anyway, there's other ones like Airbnb. Obviously, these are more expensive than PayPal is right now, hence the video I'm doing on PayPal, and it's also down in PayPal, whereas Google and Airbnb are still up on the year. And a lot of these have already run away. I want to bring Spotify. It reminds me of Meta. All these things were trading cheaper than they were in 2017, and now they're more expensive again, whereas PayPal's been stuck. So I just want to set the stage there of why I'm doing the video and why I'm looking at it now in some context and other growth companies. So I don't just always look at value companies. You need to have kind of like a garden, right? You just pick the best of different style factors, and sometimes the market will shoot them up, and then you sell them and buy the thing that it doesn't like anymore. It's kind of just how I do it. But things can stay cheap for a reason. And there are some reasons here. So let's just talk about the background. So on 7 of the 10K, let's just break it down to PayPal branded and unbranded. So that's Braintree. We'll go into Braintree in a bit. They do have point of sale as well as a few other value propositions. So Braintree, you can see here their price 2.9% to 30 cents per card digital wallet, but that doesn't really tell you what they do. And so if I had to, this is on their FAQ, if I had to pick what they said, basically their full stack payments provider, really it's a gateway for other payments. So you can put like your Visa through it, your MasterCard, Discovery, but you can also put your Apple Pay and Google Pay through it. So Braintree is a way to ride e-commerce, but not through the PayPal button. You basically split the transaction fee with the, say, Apple Pay or Google Pay. They basically split it up between them. That's what I call unbranded. So unbranded, because of this reason, has less margin for PayPal than the PayPal pure play branded button. Or at least that's what I'd argue. So when we talk about that, just visualize that. I think this will help for the rest of the video. This video will be a bit longer because it's just harder to explain. Airbnb. So these are things that use Braintree right now. So you can see that Airbnb rides on it, Messenger, GitHub, Eventbrite, Dropbox, Six Flags. So quite a few big names are already on Braintree. And this will probably only continue. It's the highest grower one, so that's one of the reasons why the margins are so bad, or not so bad, but why there's a decline in margins over time for PayPal on transaction margin is because Braintree is outgrowing the core PayPal business. Part of that is because Braintree's smaller and PayPal's more established, but a part of it is also PayPal does better, like the branded button does better during periods when e-commerce is growing quicker, as well as when there's more cross-border goods being sold. So we saw cross-border services do well the last few years, or last year and a half, but we've seen cross-border goods actually decline. So there should still be some recovery in cross-border goods over time, which should expand the margin for PayPal. This is just how they make their revenue, but so I'd say for transaction revenues, I would also argue that, say, a smaller business would pay a higher transaction fee to PayPal as a percent than a larger business would. So there's also that going on. So when PayPal is growing more through the large channels instead of the small businesses, then their margins also become under pressure as the large guys pay less as a percent of their transaction volume to PayPal. So that's another point to keep as we go through it. But honestly, if you had to look at the revenues, it's really transaction revenue, which is your net transaction fee charged to merchants and customers on a transaction basis based on the total value completed on our payments platform. There's a bunch of different things that drive it. You don't need to go into all the details there, though. Over time, the company is growing, so it's not like PayPal's stagnant on the top line. And even on the bottom line, it's not. We'll go through the numbers. It's actually pretty good lately. But one of the things they've been kind of stuck with is a transaction margin. So while revenue is growing and the bottom line is growing because of cost cutting, the margin part has been kind of stagnant for a while. And that's what the market's being focused on. It doesn't know when the margins are going to bottom. And so that's what the crux of this investment, whether it will work or not, will probably rely on that. Right now, the market's obviously pricing in more and more transaction margin declines. And at some point, it probably will bottom, but we just don't know when. But anyway, over time, you can see the business is growing quite healthily, albeit at a steady, slower rate over time. So you can see 17%, 16%, 13%. Say they get 11%. They're at 11% now. So just say it's at 11% at the end of this year. You can see the growth rate is slowing. So that would be one reason why the multiple would be coming down as well. What else is there? Here they talk about the transaction expense increasing, so that should increase with revenue, but it's increasing at a faster rate than revenue is. So while the other operating expenses, we'll go through the online items, but the other expenses are declining, the transaction expense is actually accelerating more than revenue is, and that's because of the mix. And that's why I wanted to go through the Braintree and PayPal background before we jump into it. And you can see here that they talk about the unfavorable changes in product mix with higher proportion from unbranded processing volume, which generally has higher expense rates than other products and services. So as unbranded keeps outgrowing branded, we're going to keep seeing pressure on transaction margin expense in a percent format, but it's still going to be accretive to the bottom line. It's just as a percent, it's becoming less. It's less valuable than a PayPal brand dollar. Now there is also noise, so to make things even more complicated, during COVID, like most payment processors, there's a credit card. Well, the easier example is a credit card company like a Discovery or a Capital One. During COVID, during the COVID panic, a lot of lenders basically took all these COVID provisions. And what that is basically they're providing ahead of time for losses in credit that may or may not occur, but they think it's likely that they will based on the current outlook of the economy. And so what happened is that PayPal took these provisions in 2020 because, like everybody there, kind of panicked at the onset. And then after the vaccine and after they saw how well their business did because everyone went to e-commerce goods, which helped PayPal, they actually reversed some in 2021, which made the comps very hard for 2022. So when we go annual from 2021 versus 2022, you can also see a swing that also hurt margins. And that swing also hurt them year over year. And to make things worse for PayPal, they also lost eBay, which was also one of their higher transaction margin customers. Anyway, you had like three things hit them all at once. That basically made their margins as a percent of their revenue decline. Now, PayPal hasn't sat idle. They've cut a lot of costs, and the market currently isn't rewarding the cost cutting because it's not sure when transaction margins are going to bottom. At least I'm kind of reiterating what I've already said. I just think that's the main point of this video. what else is PayPal trying to do to improve margins? So they're trying to get from just the checkout to more risk as a service, merchant lending, helping them invoice. So other things that they can add value, and that will increase their margins. So you'll see things like this PSP, and PSP for our purposes just means higher margin than their current core business. They're also trying to do things on the wallet. So if they can get you on a wallet, they know you're less likely to churn, and you're more likely to have an increase in transactions. So they are pulling some levers to try to help this margin compression they're seeing on transaction side. Total payment volume has slowed, but it's starting to accelerate again, according to them. As at the end of, they said that July accelerated and June was better than May was. May was better than April was. So we'll have to see if that's true over time or if this is just a one-off thing at the time of the call. But it is exciting that if this starts accelerating again, it may improve the volume, especially as e-commerce in general improves. And like Amazon's call, I'm also at Amazon. I think I showed that position. That's kind of my tracker for e-commerce, right? So when Amazon starts outperforming PayPal by so much, I know that it's an interesting time to think about adding PayPal. All right, and then we got the cross-border trade. So this is something that's been kind of stagnant, and this is actually a higher margin business for them. So it used to be about 14% of their total volume on the platform, and now it's down to about 12%. Now we should see this stabilize and then improve, and that should improve margin because not only do they make money on the transaction, but they also make money between the different currencies involved. They do that spread game as well. So on the transactions and engagement, so this is pretty interesting for these guys. So it's both a bull and a bear case. So one of the things that they've been doing is they've been cutting back on marketing spend, and instead they're trying to get more from their existing users instead of acquiring more users. So what that means is they're trying to get more transactions for their existing users than to try to grow and just increase the absolute number of PayPal accounts. So we've seen this kind of flat line, which is what a lot of people would look at. It's just it stopped growing on total active accounts. But you can see the transactions per account, so these are just steadily increased almost every quarter. Well, it has every quarter. And you can see not a small amount, 18%, 13%, 10%. So still pretty good, improving the traction with their existing accounts instead of going after more accounts. That's one of the reasons why their operating margins have expanded so much over years, because they've been able to cut back on sales and marketing expenses because it doesn't take the same type of cost if you're not trying to attract new users. I want to go back to transaction expense because I went through it a little bit too quickly, I think. So what it is, before we jump into the numbers, is that it's primarily composed of costs that are incurred to accept a customer's funding source of payment. What I'd say here is that the cost of funding a transaction with a credit or debit card is higher than the cost of funding a transaction from a bank or through internal sources such as PayPal. Basically, their expenses are higher when they use credit or debit cards than versus a bank. So that's something to keep in your head as well. And they also generally pay lower rates for transactions with credit or debit cards outside the US. We'll go back to the guidance after. So let's start on the quarterly. And so the quarterly is the good news. So that's what a lot of the videos are picking up that have recently been like, oh my God, PayPal's undervalued. It's because the earnings per share has improved year over year while the share price has pulled back. And that's true. So when we go through it though, you'll see kind of like two stories here. So on one hand, you have revenue growth, but it is slower than it has been in the past. So that's one of the reasons why you could say the multiple for earnings growth has also been lower. Though they did say on the call that they claim that the branded PayPal has improved in June and July, and unbranded is also still growing quite strong, 30% year over year in the quarter. So top line's actually doing okay. It is slower, but the transaction expense is what's really killing them. Not killing them, but it's just making the revenue growth not as good to the bottom line. And that's the more unbranded transactions you have, the higher the expenses. And Venmo and Braintree have lower take rates than PayPal Core. They also mentioned on this call specifically that they had lower FX fees in the quarter. What else is happening? So in 2022, they actually had an increase in credit provisions because they were lending more. And now because they've stopped lending and they've now sold a lot of their lending book to KKR, they're able to incur less here. GMD, you can see though overall, is only up about 1% year over year, which is I'd say very low per PayPal. And that's the main concern with this quarter. And now they did say on the call, we'll go through some of the notes, but they did say that without some noise, it would have been about 2 to 3% growth, which is still small, but it's not 1% growth. Importantly for the earnings per share power, and the cash flow, we can see that the company's cut a lot of costs. Now, they said they would do this. They actually started doing this in Q3 2022, so it's been almost 4 months or 4 quarters now of straight improvement for these guys. And they've cut a lot of costs, and it shows up really good here. It also shows up in my metrics down at the bottom here. But a lot of scale coming out of this business. And because the share price is down, you can tell that the market is saying this isn't sustainable, and it's more worried about the GMD growth, or at least that's what I would argue at this point. So basically, it's extrapolating a further decline in transaction margins over time because it doesn't know how low they're going to go. But you can see, like, fundamentally, operating income's up 40% year over year with a share price that's down. Technically, it's down 80% from the high, but it's down about 40% year over year, even, which is pretty amazing. So you're getting something that's 46 billion cheaper, while the operating income's gone up 40% year over year. So it is definitely an interesting time, and you can see why a lot of videos have brought it up. There is also the swing in other income, though. So, and that's just from their investments. They have quite a bit. Their balance sheet is also very good. It's not Apple good or Google good, but it's still pretty good, and they are making money on interest income because they're in a net cash position. You can see that here with a net cash 14.4, sorry, cash and cash equivalents 14.4 versus their long-term debt 10.5. So they're in a net cash position, so they're not even in debt. So one of the things that's really nice, though, is when we go down to the cash flow, basically they're buying, let's just call it $5 billion a year this year, and that's nice on a share price that's only now, the company's only worth $66 billion, so they're buying almost 1/11 of them now. And this goes down every day, so it's even lower today. August so far has just been nothing but pullbacks for a lot of things, which has been awesome. They're buying a decent amount of themselves back year over year, especially as this goes cheaper, right? Like that dream $40 to $50 share. Like when you're buying at that price, you're definitely getting a pretty interesting backstop with the cash flow, right? That would be like they could almost, they'd be buying back more than 10% of themselves in a year if it stayed that cheap for that long. So that's exciting to me. So it is getting very attractive. But again, one of the reasons why revenue growth is slower, so the multiple should be lower. Total payment volume is still growing very well. They're getting more from their existing users each and every year and each and every quarter. It's worth noting here that the FX is also slowing this, so they'd actually be growing quicker if FX wasn't against them. Active accounts is the headwind as well. It is up on the year, but it's actually down quarter over quarter, so they've actually declined in number of accounts. And then you have the transaction margin trend, and we'll go in the annual. You can see this trend more clearly. It's just nothing but down. And they keep talking about how they're going to stabilize it, but so far it's never happened. I've been following these guys for over a year now, probably a year and a half. And take rate continues to go down as well. Again, that's part of the mix, but you can see what they're doing. They've cut so much cost out that the operating margin has expanded almost back to where it was in its early days. It's pretty impressive given where the take rate has gone down to. So they're better than they were last year. It's coming out ahead. And you can see that in the EPS guidance for the year is back almost at $5 a share. So when it's trading at under 60 or under 12, basically 12 times earnings, which is very good for a company that's been growing so strong. Like it's doubled over the last 7 years in size, right? It used to only be like, I think it used to only be like 450 billion in total transactional volume. And now they're doing 376 a quarter, right? So it's they've had a huge improvement in total payment volume on the platform of PayPal over time, and I do expect that to continue. It should grow with e-commerce in general, which should continue to take share from on-card or on-premise sales. And that's just my opinion. On the annual, what I wanted to do here is compare to 2017, because that's where the price is at now. It's back to 2017 levels, except there's less shares outstanding and a better balance sheet. So it's super exciting. The share price is now actually cheaper than this, but at December 31st, 2022, that's where it was at. But you can see that the revenue is more than doubled. Share price, same. It's actually cheaper because they bought back shares. So 96 billion versus 91 billion. But you can see it is a fairly similar trend in that the transaction GMD margin continues to go down and the take rate continues to go down. And we have eBay, higher share of bill pay partners. And this has been an ongoing trend. They keep making reasons why the transaction take rate's going down. But a lot of that is just because the growth of the on-branded business is better than the branded business. And that's accelerated during COVID, especially the pullback in e-commerce that we've seen over the last year. I think that's the main thing here. I just wanted to point out just how how cheap it is relative to itself. And here's another metric. So back then in 2017, when it was at this price, it was trading at 41 times earnings. Just in December 31st, it was trading at 27 times earnings. And at the end of December, it was at 19 times earnings. And now we're in August, only 8 months later, we're down to 12 times earnings. So it's getting very, very cheap. So basically the market's starting to price in like it's not going to grow. It's actually going to undergrow the market in general. It's very exciting, especially when the company is putting up so much cash flow that it can buy back so much of itself each and every quarter. So it's definitely an interesting time to look at it. But there is some hair, is what I'm also trying to point out. There is a reason why it's cheaper. The market's basically extrapolating the weakness and not rewarding the strength of the cost cutting that they've done so far. Probably because it doesn't think the cost cutting is sustainable. Basically, it's at least thinking that marketing has to pick up in order to grow the active accounts at some point. So for the guidance, like I said, almost $5 a share, $5 billion in cash flow. They're buying back $5 billion of themselves this year. So pretty big numbers for a company that's currently only down. It's under $60 a share now. Transaction margin, I've already pointed this out. It's just another slide to show this one steady decline, that they're making less per dollar sold on PayPal, through PayPal and Braintree. This it was just for my purposes to see how big the company is relative to what it is. Like I said on the annual here, you can see that they now, like this in 2022, they did 1.36 trillion in total payment volume. And in 2017, when this thing was at the same price as it is now, it was only doing 451 billion. So it's literally the platform has tripled since 2017. And we're getting the same price. So that's exciting. Not 4 times yet, but it's getting there. And that was just on 2022 numbers, which is only improved since then in terms of total payment volume, as well as operations. And the share price, the reason for the video, is that it's super cheap. As you can see here, 58.3. It's actually cheaper than how 2017 ended off. We're almost back to 2016 levels, which was company was even smaller then, but anyway, it's tripled in total payment volume, and it's about tripled in earnings too, as well as free cash flow. So it's checking a lot of boxes. Here's just another way to see the trend over time, going from only 8 billion to 27 billion in the decade, really 6.7. 12 be almost 28 or 29, whatever 2023 comes in. So pretty remarkable growth. And you can see the earnings have scaled well. This business has a history of scaling well with higher revenue. You can see it going only from 0.78 earnings per share in a year to 2 to 4. Right? So this is where they're saying they accelerated. I just wanted to show that there, so it's not just me saying it. And unfortunately, this is what on the branded side. So most of the questions on the call were defending the transaction margin because the analysts don't have a clue where it's going to come in. And to be fair, the CEO and CFO, now they're both gone. But they also didn't have much of a clue. They were just saying things were getting better. So Dan said that things are getting better in June, and accelerate again in July. And the more that branded accelerates versus unbranded, the better the sales mix for transaction margin. So if that ever stabilizes or inflects, I think the share price is going to react well to it. Because that's the main, what I would view as the main thing against it. Here they are saying that, well, transaction margin was only up 1% year over year in Q2. And they're saying if you were to take out all the noise, it would have been increased by about 2 to 3%, which isn't great, but it's better than what I just put up. Here is them saying that the PSP business is higher margin. So what they're trying to do is also bring more people to the PSP side. And for the PSP side, you can see basically what they're trying to do is get more of their branded guys into here. So basically cross-selling into invoicing, risk of the service, stuff like that, merchant lending. I thought that was worth bringing up. Here you have a negative NNA. So this is one of the things that's also going against them. If anyone looks at the active accounts, it's just going down, right? So you're technically doing what they're shrinking. But again, this is a strategic decision by them to save money. It's just to get more transactions from existing accounts instead of trying to market for more accounts. So they're actually guiding to say more NNA declines in Q3 and Q4. And I think that's another reason why the share price is declining and why we might have even more opportunity in Q3. But we'll see, it is getting very cheap, right? So it's basically pricing in weakness forever now at PayPal, I would argue. So, but they do expect that to return to growth in 2024. So that also means 2 more quarters of lack of account growth in absolute value, or an absolute number rather. Here is them saying that they expect the take rate will continue as we move through this year. So they're saying that this should be the bottoming. And then this is Gabriel, who's the acting CFO right now, till they get another one. And they think it'll move as they move into 2024. It should stabilize. We'll see if that actually happens, because so far it hasn't. It just had a history of going down. Here you can see that they're expecting their brand and checkout to keep accelerating into Q3. Basically here Gabs is saying that they don't think their business has structurally shifted and that a growth profit profile has structurally shifted to a place that's much lower than we have been historically. They're basically saying things should be revert from where they are right now. Again, they talked about their branded part accelerating. They're talking about they're buying back $5 billion worth of shares this year. And I thought this comment was interesting because it's how it's worded, sustainable EPS growth. I think that's what the market's trying to figure out, because they're basically saying your cut earnings might not be sustainable earnings growth in the future, whereas your transaction margin is a way to ensure that you keep showing earnings per share growth in the long run. And basically here Dan is trying to say that we're going to get to sustainable EPS growth in the medium term. Right now the market's very short-term focused, right? It's talking about next quarter and the quarter after that, and then the market's not sure how to price that. But it did say here that they feel comfortable seeing our EPS growth in the mid-teens range, which is pretty strong growth for a company that's only 12 times earnings. If we can actually do that, right? To be fair, this year they're growing 20% earnings per share, but that's because 2022 was so weak. Anyway, here they're basically talking about their take rates. Again, on margin, all the questions were on margin, so there's a lot of stuff here to work with. And here they're saying that they've seen a mix on PayPal to larger merchants on the brand side, which have lower take rates than the small businesses. I've talked about that at the beginning of this video. And then the Braintree side, they're also expanding to Europe, and some of those take rates are lower there as well, so that's also putting pressure. So where they're growing is also putting pressure on the take rates over time. So that's one of the things that's going against it. She shies away from guiding to 2024, basically saying Q3 we still have some headwinds, which means the market's probably pricing in Q3 weakness, because they're not saying it's going to get better yet in terms of margins, but they think in Q4 we'll start seeing less pressure, and we expect the results to improve into next year. So we'll see if that's true or not, because that's the catalyst for this to be sustainable earnings growth year over year, instead of just this one-off big 20% growth year over year that they're currently putting up in 2023. This is one of the last slides, and this is just another way to word the same thing. They got asked the same question over and over again, so they keep having to come up with the same answer, just worded in a different way. And so they expect the compares to get cleaner and overall transaction market profit growth to improve. If you adjust for the noise that we saw in Q2, the transaction margin dollar growth would have been a few percentage points stronger. So again, they're saying it wasn't just 1%. I think it's 2 to 3% that they're going to put up on a more normalized basis. Still weak, but not as weak as what they reported. They also claim that they're getting more and more scale and AI for data and stuff like that, but that's neither here or there. But the point on this paragraph was more of, on top of introducing a high number of value service like FX as a service, risk as a service, dispute authorization, they're also high margin for us. So the more they can cross-sell into other things, the more the margin should improve over time as well. So they have some levers here. We'll see how it plays out. And I've kind of already said it's fairly cheap, but this video is already longer than I want it to be. So anyway, that's PayPal. It is interesting. It's cheap. It's partially cheaper for a reason. The market's basically saying the transaction margin, they don't know where the transaction margin volume is going to go in percent terms. But the business itself continues to grow, and the earnings per share continues to grow, and the cash flow slowly continues to grow over time. Anyway, that's it. That's what I wanted to get out for PayPal, and have a great rest of your week.